Welcome to Talk Tickers. Right now, millions of people are walking around with a mobile app in their pocket that operates like one of the largest, entirely unregulated banks in the world.
Yeah, it really does.
I mean, it holds roughly $1.6 billion in deposits, and it pays 0% interest to the people who park their money there.
Zero, which is wild.
Right. It doesn't have a Wall Street address. It doesn't have a banking charter, and it isn't subject to the rigorous federal stress tests that govern the global financial system.
No stress tests at all.
It is simply selling you frappuccinos.
It is a stunning reality when you look at the raw numbers. I mean, we look at a coffee chain, but the balance sheet looks like a mid-sized regional bank that has somehow discovered the holy grail of zero-cost capital.
And that is exactly why we are taking a deep dive into this today. We are exploring a phenomenon that is completely erasing the destination of banking.
Erasing it entirely.
It is a structural shift that affects you every single day, whether you realize it or not. We are talking about embedded finance.
Yes, the invisible revolution.
Exactly. Simply put, embedded finance is the seamless integration of digital banking, payments, lending, and insurance directly into the non-financial apps and platforms that you use to run your life and your business.
It's happening quietly, right behind the screens of your favorite e-commerce sites, your ride-sharing apps, your specialized accounting software, and yes, your morning coffee routine.
Our mission on this deep dive is to explore exactly how everyday, non-financial brands are quietly transforming into financial heavyweights.
Which they absolutely are.
We're going to map the underlying mechanics of how this actually works behind the scenes. We'll follow the massive flows of money that are shifting across the global economy.
The money flows are just staggering.
And crucially, we're going to uncover the hidden controversial risks of this invisible financial revolution because, well, you cannot rewrite the rules of global finance without breaking a few things along the way.
The stakes are astronomical. I mean, we are talking about a complete rewiring of how money moves and who gets to profit from that movement.
Yeah.
But before we can truly understand how software companies and retailers are making billions of dollars off this trend, we have to look at the underlying plumbing that makes it all possible because, this didn't happen overnight.
Right. You can't just declare yourself a bank on a Tuesday.
Definitely not.
The foundation of this shift actually dates back further than most people think.
It really does. To grasp the core concept, we have to look back to a highly controversial philosophy articulated by Bill Gates all the way back in 1994.
Wow, 1994.
Yeah, he famously told the banking industry, banking is necessary, banks are not.
That is a wildly bold statement to make in 1994. I mean, we are talking about an era where you still had to physically walk into a marble building, wait in a velvet rope line, and hand a paper slip to a teller just to move your own money around.
Exactly. The friction was the defining characteristic of the experience, but the statement was incredibly prescient.
How so?
Well, what he meant was that the function of banking, the storing of value, the movement of money across borders, the assessment of risk to provide credit, those functions are absolutely essential to the survival of a modern economy.
Right. You can't have an economy without them.
But the traditional monolithic institution of a bank, the marble building, the rigid operational hours, the siloed infrastructure that's just one delivery mechanism for those functions, it is a wrapper.
Ah, wrapper. That makes sense.
Yeah. Embedded finance is the ultimate realization of that 1994 vision. It strips away the wrapper, it takes the essential functions of banking and makes them a natural, invisible part of any customer journey without the customer ever realizing a traditional bank is operating in the background.
Okay, let's unpack this because there's a lot of jargon thrown around in this space and we need to be incredibly precise.
For sure.
People constantly hear terms like banking as a service or BOSS, and they hear embedded finance, and they tend to use them interchangeably in boardroom decks. But they are not the same thing.
They are absolutely not the same thing, though they rely entirely on one another to exist.
Right.
Think of them as two very distinct layers of the exact same ecosystem. Banking as a service, or BOSS, is strictly the back-end plumbing.
The plumbing. Okay.
Yeah, it involves fully licensed, heavily regulated banks, literally renting out their underlying infrastructure, their balance sheets, and their regulatory compliance frameworks via APIs.
Let's stop right there and look at that dynamic. A legacy bank has spent 100 years building up regulatory goodwill.
Oh, massive goodwill.
They have the federal charters, they have the FDIC insurance framework, they have the massive capital reserves required by law.
Right.
And through BOSS, they were essentially saying to a nimble 2-year-old tech startup, We have the highly regulated vault. We have the regulators off our backs. We will let your modern software talk directly to our vault for a fee.
Precisely. BOSS is the secure pipeline between the old world and the new world. Embedded finance, on the other hand, is the customer-facing layer.
The part we actually see.
Exactly. It is the actual tangible integration of a financial product, like a working capital loan, a parametric insurance policy, or a cross-border payment gateway right into a checkout flow or a software dashboard. It is what you, the user, actually click on.
So if I'm mapping this out conceptually, think of it like a restaurant. Buy is the wholesale food supplier dropping off ingredients at the back door.
I like that.
And embedded finance is the beautifully plated meal served to the customer in the dining room.
Yes, exactly.
The customer doesn't care about the supplier. They just want the seamless dining experience. They never see the back door. They just see their app issuing them a branded debit card.
That is a fantastic way to visualize it. And to maintain that illusion flawlessly, there is a very specific 3-layer structural architecture at play in every single one of these transactions.
Okay, what are the layers?
First, sitting at the very top, you have the platform. This is the non-financial distributor.
Like the brand.
Right. It could be a software as a service company for plumbers, an e-commerce marketplace, or a retail fitness brand. Their single greatest asset is that they own the customer relationship. They have the daily engagement.
They have the eyeballs.
Exactly.
Yeah.
Second, sitting in the middle, you have the enabler. This is the technology provider.
A middleman.
Yeah, this is the fintech company that employs the engineers who build the complex APIs. They are the kitchen staff in your restaurant analogy. They translate the modern agile code of the platform into the archaic legacy code of the banking system.
Got it. And the third layer.
Third, sitting at the foundational bottom, you have the bank. This is the actual chartered financial institution providing the deposit accounts, the lending capital, and the heavily regulated balance sheet. The bank takes on the ultimate systemic risk.
The platform, the enabler, and the bank. The distributor, the translator, and the vault. It is an incredibly elegant division of labor.
It really is beautifully designed.
And now that we understand exactly how this plumbing works and who does what, let's look at how this plays out in the real world. Because this isn't some theoretical white paper concept.
No, this is happening right now.
Starbucks proved you can hold billions in consumer cash. But the real leverage isn't just holding consumer cash. It is the sheer volume of that capital and how it completely bypasses traditional financial friction. Let's look at the mechanics of this coffee empire.
When you look at Starbucks through the lens of embedded finance, it stops looking like a coffee chain, and it immediately starts looking like a highly sophisticated, unregulated financial institution.
The numbers here are just staggering, and we really need to dwell on them. Through their rewards app, customers voluntarily load their own money onto digital Starbucks cards.
Which is brilliant on its own.
They pre-fund their caffeine habits. And when you aggregate all of those individual $20 and $50 balances, millions of customers are essentially loaning Starbucks roughly $1.6 billion at any given moment.
What's fascinating here is the sheer audacity of the unit economics. Let's compare this to a traditional chartered bank.
Okay, let's compare.
If a traditional bank wants to acquire $1.6 billion in deposits, what do they have to do? They have to build physical branches.
They have a real estate?
Yeah, they have to run massive national advertising campaigns. Most importantly, they have to pay a competitive annual percentage yield interest to the customer just to convince them to leave their money in the account.
Right.
The cost of acquiring and maintaining that capital is massive, and it constantly eats into the bank's net interest margin.
But Starbucks completely inverts that model. They are receiving a $1.6 billion loan from their customers at a flat 0% interest rate.
Zero.
They don't pay you a yield. They acquired this massive pool of capital simply by offering the promise of future coffee and a few gamified loyalty stars on a mobile screen.
It is the cheapest source of corporate capital on the planet. And it raises an immediate, glaring question for anyone who understands financial markets. If they're holding $1.6 billion in customer funds, why aren't they regulated like a traditional bank?
Yeah, why aren't they?
Why isn't the federal government knocking on their door, demanding to see their capital reserve ratios and subjecting them to systemic stress tests?
Right, because if you or I started taking deposits from millions of people tomorrow, we would be in federal prison by Friday.
We absolutely would be. But Starbucks survives on a brilliant regulatory loophole that is completely inherent to the mechanics of their specific system.
Closed loop.
Exactly. The funds loaded onto a Starbucks app are part of what is called a closed-loop system. That money can only be exchanged for coffee, pastries, and merchandise strictly within the Starbucks corporate ecosystem. There is no fiat off-ramp.
It is a one-way street. Once the dollar goes in, it turns into a Starbucks token, and it can never become a US dollar again.
Precisely. Because it cannot be converted back into cash and withdrawn at an ATM, Starbucks completely bypasses traditional banking regulations.
Right.
They are not legally acting as a custodian of fiat currency in the eyes of the regulators. Therefore, they don't have to hold those funds in segregated, safeguarded trust accounts. They aren't forced to park a percentage of that capital in low-yield government bonds just to satisfy liquidity regulators.
So they have a massive, unencumbered pool of zero-interest cash that they can deploy however they see fit.
Any way they want.
They can use your coffee money to fund corporate operations, to open new stores in emerging markets, or to aggressively expand their global supply chain, all without having to take out high-interest commercial loans from a traditional bank.
And the profitability of this closed-loop model gets even more intense when you factor in the accounting phenomenon known as breakage.
Oh, breakage is fascinating.
It's the industry term for gift card balances, or loaded app funds that are simply forgotten, lost, or never spent. People lose their phones, they forget their passwords, or they just leave $1.50 sitting in the app forever.
It adds up.
In a single recent fiscal year, Starbucks yielded roughly $155 million in pure profit just from breakage.
That is $155 million of pure, unadulterated bottom line profit. That is money deposited for a service that was never rendered, and because it is a closed loop, the liability eventually just vanishes, dropping straight to their corporate equity.
It's basically free money.
Furthermore, by keeping millions of daily transactions entirely within their own proprietary app, they bypass millions of dollars in interbank processing fees and swipe fees that they would otherwise have to pay out to the major credit card networks. It is a masterclass in financial engineering masquerading as a loyalty program.
It is. But as massive as the consumer side, the B2C side is, the business-to-business side is arguably seeing an even more profound systemic transformation.
Oh, definitely.
To understand where embedded finance is truly reshaping the economy, we have to look at the infrastructure that powers small and medium businesses. Let's look at Shopify.
Okay.
They started out as a relatively simple software platform. Their entire value proposition was just helping people build visually appealing online storefronts.
They're just a software as a service company. You paid a monthly subscription fee, and they gave you the digital tools to sell your handmade soaps or your custom t-shirts on the internet.
They did. But as they watched their merchants operate, they recognized a massive, glaring inefficiency. Their merchants had critical financial needs. They needed to process complex global payments. They needed fast access to working capital to buy inventory before the holiday rush. They needed corporate cards to pay for Facebook ads.
And banks weren't helping them.
Exactly. The traditional banks were completely ignoring these small merchants or subjecting them to incredibly painful, slow underwriting processes. So Shopify realized that the software was just the hook. They evolved from being an e-commerce software provider to becoming a comprehensive financial hub for their merchants.
They aggressively rolled out the financial stack. They launched Shopify Payments to handle the actual transaction processing and capture the interchange fees.
Right.
Then they rolled out Shopify Capital, which is their lending arm, offering instant cash advances directly to merchants. And most recently, Shopify Balance, which provides actual functional business bank accounts and corporate debit cards to the merchants running on their platform.
And if you want proof of how powerful this shift is, you just have to look at the divergence in their revenue growth.
The numbers are crazy.
If you look at their core software as a service business, the traditional monthly subscription fees that merchants pay just to use the software platform, that segment is growing at a respectable, healthy 8%.
Which is normal for SaaS.
But their merchant solutions segment, which is almost entirely comprised of these embedded financial services like payments and lending, is growing at a massive 29%.
Wow.
The financial services are vastly outpacing the software itself. The software is merely the distribution channel for the finance.
Here's where it gets really interesting, though, and I have to push back a little on the framing here.
Okay, go for it.
Are companies like Shopify and Starbucks truly acting as banks? Or are they just highly effective marketers creating these sticky, closed-loop loyalty traps to keep people locked into their specific software ecosystems? I mean, they do not possess actual banking charters. If you ask the Federal Reserve, they are not banks.
It is a totally fair question, and it is the exact debate happening in regulatory circles right now. But the functional reality is that the line between a software company and a bank is completely blurring.
Blurring how?
You have to look at it not from the perspective of a federal regulator, but from the perspective of a small business owner using the platform. If Shopify is the entity holding your daily sales revenues in a deposit account, if they are the ones issuing your corporate debit card so you can buy supplies, if they are processing every single one of your customer payments,
right,
and if they are serving as your primary instant source of working capital for your inventory, well, in every practical, functional, day-to-day sense, they are your bank. The regulatory charter is just a piece of paper sitting in a filing cabinet in Washington. The functional reality on the ground is that the software platform has entirely replaced the traditional banking relationship.
Wow. When you frame it like that, the software itself is the bank. You don't log into a banking portal, you log into your inventory dashboard, and the banking is just a feature of your inventory management.
Exactly. It's invisible.
And if coffee shops and e-commerce platforms can pull this off with such incredible success and margin expansion, it brings us to the real titans. If a coffee company can hold $1.6 billion, then the tech monopolies, the companies that have billions of daily active users and market caps larger than the GDP of major nations, are positioned to completely rewrite the global financial system from the ground up.
Oh, without a doubt.
Let's look at the big three, Apple, Google, and Amazon. They're all attacking the embedded finance space aggressively, but they're doing it in completely different, highly strategic ways.
Yes, and their distinct approaches perfectly reflect their broader corporate identities and their ultimate end goals. Let's start with Apple.
Okay, Apple.
Apple's entire corporate philosophy, dating back decades, is about absolute control. Is about owning the consumer experience from end to end, controlling both the hardware and the software. They are applying that exact same philosophy to money by embedding finance directly into the iOS operating system itself.
Right. The Apple Wallet is no longer just a digital folder to store a QR code for a boarding pass or a digital movie ticket. It has become a centralized, heavily integrated financial hub.
And it really has.
But the biggest flex the move that really sent shockwaves through the legacy banking sector was the rollout of Apple Pay Later. This is their buy now, pay later product that allows users to split purchases into 4 interest-free payments.
Yep.
But the crucial detail isn't the feature itself. It is the underlying mechanism of who is actually financing that debt. It is not a third-party partner bank taking the risk on their balance sheet. It is financed directly by a subsidiary they created called Apple Financial LLC.
And we cannot overstate what a massive paradigm shift that is. Historically, tech companies always partnered with banks because they didn't want the risk of loan defaults.
They hated the risk.
But Apple is utilizing its own enormous, unprecedented corporate cash reserves to underwrite consumer credit directly. They don't need to borrow money from the Federal Reserve to lend it to you. They just use their own mountain of cash.
That's incredible.
They are controlling the physical hardware of the iPhone, the iOS operating system, the digital wallet interface, and now the actual credit facility and the balance sheet risk. They own the consumer's financial life entirely, cutting out the legacy banks almost completely.
Now, contrast that holistic consumer dominance with Google. Apple obviously has the capital to just buy a bank outright if they wanted to, but they are building it piecemeal.
Yeah.
Google's strategy couldn't be more different.
Exactly. Google is not trying to be a consumer bank. They actually tried launching consumer financial products in the past. They had a highly publicized project called Plex that was meant to offer smart checking accounts, and they completely pivoted and shut it down.
Oh, I remember Plex.
Yeah. They realized the consumer banking space is too crowded and too fraught with customer service friction. Instead, Google is focusing entirely on the back end. They want to own the infrastructure.
But pipes.
Right. Their strategy involves migrating massive legacy financial institutions. We are talking about major historic players like Wells Fargo and KeyBank onto Google Cloud.
So while Apple wants to be the interface for the consumer, Google wants to be the invisible underlying rails that the entire traditional banking industry runs on. They want to be the landlord of the financial system's data.
Correct. Google recognizes that legacy banks are terrified. These traditional banks know they need agility, they need advanced artificial intelligence, and they need massive scalable computing power just to survive the digital transition and compete with the nimble fintechs.
And Google provides all of that.
Yes. By providing that essential cloud infrastructure, Google positions itself as the indispensable foundation of modern finance. Why take on the intense regulatory scrutiny of underwriting consumer loans if you can simply power the AI algorithms that the banks rely on to underwrite those loans?
Wow.
Google gets paid regardless of whether the loan defaults or not because they are charging for the compute power.
It is the ultimate picks and shovels strategy during a gold rush. And then there is Amazon. If Apple's strategy is owning the consumer and Google's strategy is owning the infrastructure, Amazon's strategy is owning the transaction.
Amazon's focus in the embedded finance space is intensely zeroed in on the B2B side, specifically focusing on merchant lending and working capital. And their advantage here is almost unfair.
Unfair how?
They have an unparalleled granular view into the global supply chain and real-time consumer demand.
Right, because they see the real-time sales data of every single merchant operating on their massive platform. Think about the difference in underwriting. A traditional bank asks a small business owner for a PDF of their quarterly financial statements, which are literally out of date the moment they are printed.
Exactly.
The bank is looking in the rearview mirror. Amazon doesn't look at quarterly statements. They look at absolute real-time omniscience. They know exactly how many units a seller moved yesterday at 4 p.m.
Down to the minute.
They know exactly what the merchant's return rate is.
Yay.
They know exactly how much inventory is sitting in a fulfillment center in Ohio versus a container ship in Long Beach.
Which means Amazon understands a merchant's underlying credit risk vastly better than a traditional bank ever could. A bank sees a dip in revenue and panics. Amazon uses advanced real-time data modeling to understand why the revenue dipped, and they offer working capital and revenue-based cash advances tailored to that specific reality.
Well, that's smart.
If a merchant has a slow sales month because of a supply chain hiccup, the repayment schedule on their Amazon loan automatically adjusts downwards because Amazon literally controls the cash flow and intercepts the revenue before it ever hits the merchant's external bank account.
So get paid first.
Always. It is what we call algorithmic empathy, scaled infinitely through data. They only lend to the merchants they know mathematically cannot fail.
So what does this all mean for the future of the economy? We have these three titans. If Apple has an endless supply of cash, Google has the servo farms to power the world, and Amazon has absolute omniscience over transaction data, why don't they just go all the way? Why don't they just apply for official federal banking charters and wipe out the traditional banking competition overnight?
What's fascinating here is the highly deliberate, highly calculated strategy of regulatory avoidance.
Regulatory avoidance.
Big tech companies want the massive, high-margin revenue streams that come from offering financial services, and they desperately, desperately want the granular behavioral data that comes from processing financial transactions. But they want absolutely nothing to do with the heavy regulatory burdens that come with being a legally chartered bank.
Because being a heavily regulated bank sounds exhausting, and it destroys your tech valuation multiplier.
It does. If Apple or Google became officially chartered banks, they would be subject to strict deposit insurance requirements. They would face massive capital reserve mandates that would tie up billions of dollars in dead cash.
That cash isn't doing anything for them.
Right. And most importantly, they would invite intense systemic risk oversight from federal regulators. They would have to allow government examiners to routinely scrutinize their inner workings, their algorithms, and their corporate governance in a way that secretive tech companies absolutely loathe.
Yeah, they do not want the government looking at their source code.
By partnering with sponsor banks in the background or by operating in cleverly designed adjacent gray areas like we saw with Starbucks, they capture the massive economic value of banking while completely outsourcing the regulatory nightmare.
Okay, so big tech is playing this massive multi-trillion-dollar game of 4D chess. But across the broader economy, beyond the monopolies, there is a massive pie up for grabs for normal software companies and digital brands. We are looking at a $20 billion revenue pool in embedded finance right now, and market analysts project that pool to double in the next 3 to 5 years.
It's a gold rush.
It really is. But who exactly is capturing that cash? If you break down the value chain between the platform, the enabler, and the bank, who actually gets paid?
It is not a uniform split. It entirely depends on the specific financial product being embedded. You have to divide the economics into two distinct categories, lending products versus payment and deposit products.
Okay, let's start with lending.
Let's look at lending first, things like merchant cash advances, embedded credit cards, or buy now, pay later. In lending, the fundamental rule of finance applies. The entity that takes the risk gets the reward.
Naturally.
The balance sheet provider, which is usually the legacy institution, actually risking its own capital against the possibility of the consumer defaulting, captures the vast majority of the revenue. In a typical embedded lending arrangement, the balance sheet provider captures roughly 55% of the economics.
So if a niche software company offers a $10,000 loan to one of its users, but a partner bank sitting in the background is actually providing the funds, the bank takes the lion's share of the profit because they're the ones left holding the bag if the user goes bankrupt and defaults.
Exactly. The software company gets a nice origination fee, but the bank gets the major yield. However, the economics flip completely when you look at payments and deposits.
Also,
In these categories, the risk of default is virtually non-existent. You are just moving money from point A to point B or holding it in an account. Therefore, the distributor, the non-financial brand or software platform that owns the user interface and the customer relationship, takes home the lion's share of the revenue.
yeah.
They capture the value simply because they control the access to the customer's attention.
And this dichotomy in the unit economics brings us to a really fascinating, highly aggressive playbook that these non-financial platforms use to capture this revenue. It's a strategic four-step approach known in the industry as land and expand.
It is a highly methodical, almost predatory strategy. Step one is simply understand the customer journey. The platform deeply analyzes how their users operate on a daily basis within their software.
Step two.
Step two is identify financial touch points. They look for moments of high friction where money needs to move: a user paying a vendor, a small business waiting 30 days for an invoice to clear, or a merchant needing capital to buy raw materials. Step three is the crucial pivot: integrate services at the point of need. The platform embeds a simple, low-friction financial product, like a basic payment processing gateway, right into the dashboard where the user is already working.
And then comes step four, which is where the real money is made: extend services. Once the user adopts that first simple product, the payment gateway, the platform begins gathering exclusive proprietary cash flow data. They see every dollar coming in and every dollar going out. They then use that exclusive data to underwrite higher margin products later, like heavy loans or revolving credit lines.
That's the expand part.
It's exactly like the freemium software model. You offer the payment integration at a low margin to get them hooked into your ecosystem and harvest their data. Once you know their habits, you upsell them on the high-margin lending products.
That is a perfect comparison. It is a data-driven Trojan horse. And this highly effective strategy is exactly why we are seeing such explosive, unchecked growth in the embedded finance sector. But it brings up a critical, highly complex logistical issue.
What's the issue?
If a non-financial business, let's say a specialized accounting software company for freelance graphic designers, or a niche marketplace for vintage car parts, wants to execute this land and expand strategy, they can't do it alone. They do not have the engineering bandwidth, the deep compliance expertise, or the regulatory licenses to build a functional bank from scratch.
Right. A SaaS founder doesn't want to spend 3 years applying for a charter. They need to hire an enabler. They need to plug their software into an infrastructure provider that already has the pipes built.
Exactly.
And this market of enablers has absolutely exploded into a highly fragmented, complex landscape. So let's categorize the major players who are actually building the rails for this technology. Let's group them by their unique structural advantages.
The geography is the single most defining factor here. Let's look at Europe first, where stringent, highly structured regulations strongly dictate how the market operates. In Europe, you have providers specializing in regulated EU infrastructure. ConnectPay is a prime example of a specific model. They hold what is called an electronic money institution, or EMI, license. This provides built-in compliance specifically designed for European SaaS platforms.
Okay, an EMI license.
But an EMI license is limited. It allows you to hold funds and process payments, but it strictly prohibits you from lending out customer deposits. Then you have a player like Solaris, which goes a massive step further. Solaris holds a full, unrestricted German banking license.
Oh, wow, a full license.
Yeah, this allows them to offer enterprise-grade embedded banking, including heavy lending, because they have the ultimate regulatory clearance. And then you have highly agile players like Swan, which focuses heavily on European startups that simply need to instantly issue IBAN's international bank account numbers without getting bogged down in years of compliance paperwork.
So Europe is heavily defined by what specific license the enabler actually holds. Moving over to the US, the environment is radically different.
Very different.
The US relies heavily on a patchwork system of sponsor banks. Here you have tech platforms specializing in startup and bank integrations. You have massive players like Stripe Treasury and platforms like Unit, which are famous for their developer-first APIs.
And this is the key distinction with them. Stripe, Treasury, and Unit do not have banking licenses themselves.
Oh, really?
Nope. Instead, they operate as middleware. They are backed by a hidden network of chartered partner banks. They make it incredibly easy for a startup founder to write a few lines of code and suddenly offer a fully functional bank account, while the underlying sponsor bank quietly assumes the regulatory risk.
I see.
And then you have platforms like Treasury Prime, which operate slightly differently by offering direct API links into a network of U.S. banks, giving the software platforms a bit more direct, granular control over the actual banking relationship, rather than abstracting it away completely.
And as these software companies scale internationally, the complexity multiplies, and they need global and marketplace payments providers. Adyen is a massive, dominant player here, providing enterprise-level global acquiring.
They are huge.
Acquiring means they provide the complex infrastructure that allows huge platforms to actually process and accept credit card payments from almost anywhere on Earth, navigating thousands of localized banking systems.
Right. And Payoneer is another giant, but they specialize in global payouts, which is perfect for a massive gig economy marketplace that needs to seamlessly pay thousands of freelancers or independent sellers in dozens of different countries and local currencies simultaneously.
That sounds like a logistical nightmare to build yourself.
It is. AirWallex also dominates this global space, focusing heavily on multi-currency wallets and automated foreign exchange infrastructure, eliminating the massive friction of cross-border commerce.
And if your specific goal is to issue physical or virtual debit cards to your users, you have to look at card issuing and cross-border specialists. Marqeta is the absolute, undisputed leader in modern card issuing APIs.
They really are.
To put this in perspective, if you use a major food delivery app and the driver goes into the restaurant and pays for your specific order with a company-issued debit card that was funded with the exact amount of your purchase just 3 seconds prior, that instantaneous funding and card authorization is likely powered by Marqeta.
It's seamless. And then you have players like Banking Circle, which provides deeply regulated cross-border infrastructure, usually operating entirely in the shadows to serve other payment service providers rather than interacting with direct consumer brands.
Finally, you cannot ignore the traditional heavyweights. These are the massive, deeply entrenched legacy players that are desperately adapting to the embedded world so they don't become obsolete. Clearbank in the UK is fascinating because they offer direct access to the country's central clearing system, bypassing the traditional clearing banks entirely.
Yeah, and Fiserv, which is one of the oldest and largest financial technology companies globally, provides the massive enterprise-scale legacy integrations that huge traditional institutions require to attempt to stay competitive with the nimble fintechs.
Okay, that is an incredibly dense, massive list of heavy hitters with wildly different capabilities. If I'm a founder listening to this, how do I even begin to choose?
It is deeply daunting, and making the wrong choice can literally bankrupt a startup. You have to ruthlessly evaluate them based on 3 strict criteria.
Yeah, what's the first one?
First, geography. Financial services are deeply inherently localized by sovereign laws. An EMI license in Europe operates under completely different legal frameworks than a sponsor bank model in the United States. Your infrastructure provider's regulatory footprint must perfectly match where your actual user base lives and transacts.
Makes sense. And the second?
Second, the core use case. You have to be incredibly specific about what friction you are trying to solve. Do not buy a massive, complex lending and card issuing API if all your marketplace actually needs to do is execute simple cross-border payouts to a few hundred freelancers. Buy the highly specific, lightweight tool for the specific job.
And the third criteria, because you said this one is the most dangerous.
The third is compliance ownership. And this is the most critical point of failure in the entire embedded finance ecosystem. You must clearly, legally understand who is actually handling the KYC Know Your Customer and the AML anti-money laundering regulations.
The legal soap.
Exactly. When a user signs up for a bank account on your software platform who is verifying their identity against federal terrorist watch lists, does the enabler handle it? Does the legacy partner bank handle it? Or is that massive legal burden falling entirely on you, the software founder?
That's a scary thought.
If a bad actor uses your embedded wallet to launder money? Who gets the federal indictment? If you don't know the exact answer to that question, you are taking on catastrophic existential risk.
Which brings us, inevitably, to the most vital part of this entire deep dive. Up until now, we have painted a picture of seamless convenience, frictionless digital checkouts, brilliant APIs, and massive, massive profits.
The rosy picture.
Right. But there is a dangerous hidden side to stripping away the friction of traditional banking. We have to talk about the dark side of embedded finance and the systemic risks that are currently terrifying federal regulators.
And this dark side is exactly why those regulators are starting to wake up and aggressively intervene. The regulatory spotlight is violently shifting.
Shifting where?
Well, for years, regulators focused on the flashy tech startups. But now, the spotlight is shifting away from the fintechs and directly onto the legacy sponsor banks sitting at the bottom of the stack. For the last decade, these sponsor banks happily enjoyed the massive influx of cheap deposits brought in by their software partners, while often turning a blind eye to how those software partners actually operated or marketed their services.
They were just collecting the fees.
Exactly. But regulators are now making it unequivocally, painfully clear a chartered bank cannot outsource its compliance responsibilities to a tech company.
The data on this is actually shocking when you dig into it. A highly significant 13.5% of all severe enforcement actions handed down by federal banking regulators recently were targeted specifically at banks involved in Basel's partnerships.
That is a massive, glaring overrepresentation. It shows that regulators are actively cracking down on legacy banks that fail to properly monitor the non-financial tech brands they are empowering. The banks thought they were just renting out pipes. The regulators are telling them they are responsible for the water flowing through those pipes.
And the risk isn't just regulatory fines, it is deeply structurally technological. We are talking about cybersecurity and the absolute nightmare of fragmented data. In the old world, a bank transaction happened entirely within the bank's secure mainframe.
Nice and contained.
But in this new embedded ecosystem, a single transaction travels from a merchant's unsecured website through a fintech enabler's cloud-based API and finally settles in a legacy sponsor bank's 40-year-old database. The attack surface for hackers has expanded exponentially.
Because security is no longer centralized behind the thick walls of a single institution, it is highly fragmented across dozens of interconnected third-party vendors, many of whom have completely mismatched security protocols.
It's a chain, and it's only as strong as its weakest link.
Exactly. And the statistics reflect this severe vulnerability. Currently, 15% of all major data breaches stem directly from vulnerabilities in third-party vendors. If a retail clothing brand's embedded finance platform gets hacked because a developer left a cloud bucket open, it is the sponsor bank sitting quietly in the background that suffers the massive reputational damage and the catastrophic regulatory fines.
Wow.
The highly regulated bank essentially bears the systemic risk of a retail company's poor cybersecurity hygiene. It is a precarious house of cards.
Beyond the systemic risk to the banks, there is also a profound, immediate risk to the average consumer. We need to talk about predatory convenience, specifically looking at the absolute explosion of buy now, pay later, or BNPL products.
Yes. Buy now, pay later is perhaps the most visible, ubiquitous form of embedded finance for the average consumer today. It embeds the instantaneous creation of unsecured debt directly into the checkout flow of a shopping cart, right next to the submit order button.
The issue here is deeply psychological. Embedding debt at the exact emotional moment of purchase completely removes the natural friction that gives consumers the necessary time to think.
They don't have time to reconsider.
Right. It obscures the reality of taking on debt and leads to overspending, drawing the ire of consumer protection bureaus. But wait, hasn't the entire goal of the tech industry for the last 2 decades been to eliminate friction?
It has been.
Now we're saying friction is actually a necessary safety feature.
If we connect this to the bigger picture, you have to realize that the rules of software do not inherently apply to the rules of money. They are fundamentally different domains. In e-commerce, friction costs sales. Every extra click reduces the conversion rate. But in finance, friction prevents ruin. Friction is the necessary moment you actually read the 24% interest rate. Friction is the moment the underwriter pauses to check your debt-to-income ratio to ensure you have the ability to repay. Blurring the two creates a dangerous ethical conflict for platforms.
That is a profound distinction that completely changes how you look at the apps on your phone. In e-commerce, friction costs sales. In finance, friction prevents ruin.
Exactly.
We have covered incredible ground today, diving deep into the plumbing of the new economy. Let's synthesize what we've unpacked. Embedded finance is fundamentally turning every company from coffee chains to software providers into a fintech. By utilizing the complex three-layer architecture of front-end platforms, agile API enablers, and legacy sponsor banks, non-financial brands are entirely bypassing traditional banking channels and capturing massive new revenue streams.
It is unlocking unprecedented economic value, it is streamlining global business operations, and it is fundamentally changing the very definition of what a bank actually is. But as we've seen, it is bringing highly fragmented cybersecurity risks, complex vendor vulnerabilities, and absolute regulatory nightmares along for the ride. The system is moving faster than the safeguards.
It is an invisible revolution happening right inside the apps on your phone,
Oh.
which leaves you with one final massive thought to mull over. Think about this. If every retail brand, social network, and software platform begins holding consumer funds, issuing credit, and processing payments entirely within their own ecosystems, do corporate loyalty points and digital balances eventually threaten the sovereignty of national currencies?
It's a huge question.
When a company's closed-loop economy becomes larger than a small country's GDP, who is really printing the money?
It is the exact question that central banks around the world are going to have to answer very, very soon.
Something to keep in mind the next time you casually load $20 onto your coffee app. Thank you for joining us on this deep dive. Keep questioning the markets, and we will catch you next time on Talk Tickers.